From the 5.5-year lows late last year, gold has been in recovery mode, currently up 18% from the intraday low print on the 3rd of December 2015, although the rally has stalled and the price action has not been strong enough to lift it away from recent highs of $1,285 an ounce. Ron William is Senior Tactical Strategist at ECU Group. He joins us now with some more. Ron, welcome. We've spoken about gold before, and in fact, a couple of your charts I know you want to talk about today we have already seen in the past, but of course we've had this extra development recently of the drop down to those December lows and the recovery. And your thesis now is that we're at the beginning of something more exciting, I believe.
Yes, well, there's still more to come, and at the moment it's a two-step move after such an aggressively overbought conditions that we built up after that 18 to 20 or so percent move higher over in just 2 months. What we now need to see is a further unwinding from that overbought condition, which we last saw in 2012, so some years ago. That move could take us down to roughly $1,200, so just a very short-term temporary correction on the downside before the big move up to above the March high at 1288 onto 1480, 1500. These are the technical levels we're looking at on a short-term basis.
Okay, well let's look in some more detail at this and just illustrate what you've just been here talking about and where we are and where we're going. The bottom here, most overbought since 2012. We've come away from that. There's a lot of indicators here on this chart. Just talk to us a little bit more about what's going on.
Well, essentially, we've broken out this 2012 downtrend just drawn there. That's the initial breakout level. And then the target, one of the targets there, just the 2012 trend at 1405. Now, the indicator on the bottom is the RSI momentum indicator, just showing what you just mentioned there, that the historical context of this overbought condition. But essentially, we're looking for a two-step process down to maybe 1200 and then back up all the way to 1480 second half of this year.
Yeah, but you're still saying, aren't you, that the long-term bull run is still very much alive?
Well, this is it. I mean, here we're looking at the most recent impressive move on gold. But on the long-term chart, this is the one we looked at some time ago in the last interview, showing this long-term mean line, trend mean line that I drew back then. Intact. So the long-term gold trend is still intact from 1999, but that's after a 45% drawback. So of course it became the most hated market over those 4 years. But then from a contrarian perspective, that's what made it very oversold and in fact created one of the largest net short positions in over 15 years. Now, one of this also coupled with a trend exhaustion pattern. So it's a price and time pattern here that has led to this reversal.
You've also on the far left-hand side of the chart here, I want to talk about the probability chart that you've got there, the probability distribution, I think that is. How does that work?
Well, this measures basically each of the ticks on price ticks on the gold chart and statistically presents where the value zone is. And currently, that value zone is at that support level I mentioned to you at $1,200. So it's offering some substantial support at the moment, but also it suggests a potential projection up to 1480. So it's a double confirmation to the price levels that we were referring to. Yeah.
Okay. Let's move on to the next chart as well and explain more about what's going on here. Now, I haven't seen this one before.
Well, this time is different for many reasons, and not least because it's this mega 8-year bottom or rhythm in the market that has been reactivated again on gold. And in this year, and what it does suggest is a big sea change of psychology for the yellow metal. It is now likely to be perceived once again as that safe haven play, not least again because the second half of this year also has a lot of political uncertainty with Brexit just around the corner and the US elections, which have been on the newswires on a regular basis. So all of this uncertainty, not good for investment sentiment, but very good for potential safe haven trades back into gold.
Yeah, away from equities.
Away from equities, as the next chart shows, and this shouldn't be a big surprise after the record volatility we saw in January. That's when a lot of portfolio managers and traders alike recognize that there are some seismic shifts in the ground taking place, certainly in the equity market and in risk markets in general. And we can see that January volatility creating this major reversal on this ratio, which is gold versus the US equities. So that a move down is gold outperforming against equities and up is vice versa. We can see that move happened in January. That was a major trend reversal. We have bounced back up to that bottom of the trend channel, but that fits within our thesis, our short-term thesis of this rollover that we're probably likely to see at the moment in equity markets as we speak into the Q2 period, which is a seasonal negative period for the equity market anyway. So that's been our view long held for a while. This ratio chart also suggests that gold will outperform versus the S&P during that time.
Yes, I think actually going back to one of your interviews we did a couple of back into last year, you were talking about potential 6,000 point loss on the Dow. Just outside of this particular interview, that is still the case then?
Well, it's the case that we're likely to see maybe a 30% or 50% drop retracement from very frothy indexes like the Dow or the Nasdaq, and people can calculate the point difference on each of the indices. We're likely to see that over the next 2 years, so this year into next year. But from a tactical perspective, if we count from now into the October period, this is when we expect to see the drawdown this year, and then once again into 2017 as well.
Right, okay. So going back to this, talking about the context of this, I just wanted to bring that up because I think it's quite interesting because gold is often perceived as a safe haven, of course. It's not just a play all by itself. Let's move on to your last chart as well and explain a bit more about what's going on here. Again, I haven't seen this one before.
So a big part of our process is model driven, and we use technical models. This is a multi-asset technical model which basically measures just about all the key assets out there if we think of currencies, commodities, fixed income and equities. And what it shows is that gold is outperforming across all of these assets in all the major currencies. So whichever way you measure it, gold is really doing well. But what's interesting is it's also, when I look at the details behind this chart, showing a defensive risk-off play, where we have not just gold, but also government bonds and cash and even inverse equities also outperforming at roughly the same time. So it suggests a real kind of risk-off period in the second half of this year, with gold leading the way.
What are the risks to this trade, do you see?
Well, the risks to this trade, the current risk on trade and equity market, bear market rally continues a little bit more. Stocks like the FANG stocks are already very strong, and just a few of them can just be goosed up a little bit in order to push the chart higher. Either way, we think this is all temporary, and the risk at the moment is more to the upside. More to the downside than it is to the upside. So we think at this stage it pays more to scale back and be defensive than anything else. So our advice would be defensive, be more tactical, and be a little bit more risk savvy as we go into the second half of this year.
Good. Okay. All right. Ron, it's a pleasure. Thanks indeed for joining us. Ron William there, advisor to the ECU Group.